let's start with some stage setting. Matt, you found some interesting comments, and we've heard some things from the EU and ECB side. So I'd like you to kind of start us there. What are you seeing coming from those EU leaders with regards to energy?
So I think, when you're looking at in the big picture, the war going on in Iran, I look to the statements from the key figures, and generally, if you can read between the lines and have a good underpinning of what's happening, they'll tell you who's winning or losing here. And I think in the last week, we got those tells, those quiet parts, being said out loud from Europe's leadership. So we'll start, Cameron, with some statements at conference statements. But number one, Europe is really admitting it's lost this phase of the Iran fight through the energy markets and the commodities channel. Everybody talks about the Strait of Hormuz, the tightness, all of that. But the real signal here is the rhetoric tells you who has access to those global supply chains. Um, and what that means, if you don't have access, if you're getting like edged out, and someone else is encroaching in on your former supply lines, what it means is higher energy costs mean weaker access, like for supply, distribution, and the like security of your access to commodity production. So that whole framework, you'll hear me talk about it a lot with the Daniel Yergin, the prize, geopolitics, reflecting access to these, resource commodities. That's going on in play here. It's been the kind of backdrop for, well over 100 years now, still alive and well today. So you look at these statements from number one was the EU economy commissioner. We don't need to even like mention his name. He doesn't show up that often, but the point is he's their economy commissioner. He's a technocrat. He admits that Europeans can expect oil and gas prices to remain above what they were before February 27th. They're going to be elevated, coming out of that for the foreseeable future, right? And they say like through 2027 as their, crystal ball, is what they're communicating for expectations. And then you see Christine Lagarde double stamp that. She said it's probably a fact that price levels will be higher at the end of this crisis, when we see the end of this crisis. So we're literally seeing the end of this crisis for now. I mean, there's further to go. I think it's not officially done until the U.S. Obtains custody and stockpiles of the uranium that's been enriched by the IRGC. We may not get that for a while, but as far as reorganizing the global energy markets, the financial system, all of that, like you're seeing right here, Christine Lagarde and this EU economic commissioner, they're telling you it's like, yeah, we lost. That's the way I see it, but they're saying literally the quiet power, they're wearing it on their sleeve. All right. So this goes to slide four. Next step. Now that they admit it, higher energy prices for Europe after the Iran action that's opened up in since the end of February, their ECB, their economic projections come out, and they now say they're making it double stamped as well. So they're saying we see lower growth, GDP growth for the entire eurozone is 0.9% real. At that point, you're like spitting distance from zero, which is real, the baseline, no real growth. You're less than 1% from that.
Yep.
And then they also took up their inflation forecast. Now, this is, key distinguishment that I think all of our audience, we want to drill this in. Price inflation measured in the CPI index in the United States or the harmonized EU price index, that's different. Those prices will rise given EU is admitting, hey, we're going to pay higher energy costs after the fact. That is different than monetary inflation, which by definition is expansion and credit, which ultimately comes down to borrowers' willingness to take on new debt, right? And we're going to get into that side of actual monetarist inflation in a second. But right now, the ECB all of the economic technocrats, they're actually admitting defeat here. Real growth down, price level, price index inflation up. And then last, number five, you get to the real payload, and this is in the ECB's financial stability review that came out, I want to say May 25th. It was this week. Um, look at these highlights. The payload is right here. If you assume those things we just talked about, which they've admitted to, or like they've conceded to, the natural output, they recognize there's going to be an abrupt repricing in sovereign bond markets. What does that mean? Yield up. Um, and then the second one, posing risks to euro area financial stability, right? So what they're saying is this sustained energy shock can force that abrupt repricing in sovereign debt yields. That'll carry through in global sovereign bond markets, right? Rates up somewhere means, hey, that gravity is going to pull bond prices down, you know, in the United States, Japan, everywhere. Um, but the deeper point is Europe is stuck paying the price for this conflict that it cannot financially or strategically control. So this is really the exact backdrop. You know, we're locked into a path now that strengthens this long run case for more centralization of European and ECB monetary control, taking away that power from the national central banks, which we've talked about in prior episodes, the gold that the national central banks have more inventories, reserves of than the ECB. That'll create a back and forth that's going to have to play out over the next 2 to 3 years. But this forces the issue forward. We're headed to this, I don't know, skunkworks project that you keep seeing floated around by ECB officials that we're moving towards this digital euro. Right? We don't have that much kind of paperwork or documentation on what the thing is. I go deep into the need for it and why it's happening on my interview with Marty Ben on TFTC that aired a couple of weeks ago. If you want to go pull deeper on that thread, but I think right now you're seeing in the real time headlines today. The U.S. and Iran negotiations have reached a point where we have, you know, it's maybe not won't be the final agreement, but we've got an agreement to get the basics in place. Now, the uranium is the bigger question. This thing's not
That's the
over
thing they care
until,
about. Yeah.
uh, yeah. But this intro phase, it's locked in, which also increases the probability that these two sides, these businesses, can handshake and work together, and ultimately that leads to that destination on the nuclear front down the road.
Right.
But I think this is the writing is on the wall for the EU, and they were admitting it in public in their statements. You know, economic forecasts, all of that. It's here. So that's that front.
So connect that to me, Matt, to what we're seeing in the U.S. money markets. I know you mentioned something to me earlier before we hopped on about the Memorial Day weekend and all of that. So I'm going to flip us to the next slide here, but maybe what are you seeing and why specifically highlight the Treasury curve and the Treasury actives curve and then this 1 month uh,
Okay.
rate?
This is where the rubber meets the road for what we talked about, the difference between CPI inflation, which if Eurozone admitting higher energy prices, that means their currency is going to lose, you know, access on the margin to energy commodities and its currency's purchasing power of those commodities and others, metals, agri commodities, all of that on the international market where these things just freely trade and everybody has to compete. Um, that's CPI inflation. Now we talked about real, like monetary inflation, which is expansion of credit. What we saw on Monday in the 4 week T-bill, and then you can go into it on term, SOFR as well in repo markets, short term funding markets. This is your smoking gun. That monetary inflation exists right now. So what's happening? That expansion in or that rise in cost inputs for say Europe in particular is showing up in its private sector, um, reducing its demand for money or new credit creation. All right. So we're going to like walk through how I get there. All right. So we saw on Monday, US markets were closed for most of the day. We had skeleton crews like up until 1 p.m. Eastern time, and then everybody gets to go home and enjoy Memorial Day for afternoon and evening. But we saw something, really kind of incredible in the 4-week Treasury bill. Why is that important? It's your shortest term T-bill IOU that, makes up you think about the US Treasury debt as being the risk-free asset or lowest risk asset in this credit dollar framework that's dominated since, let's say, 1971, but really took off in the 80s. We talk about that all the time. Um, this is your premier deepest liquidity pool collateral asset in that IOU kind of framework. And like it's tip of the spear in the money markets, which is short-term dollar lending. This is where money gets both stored and, created. Like it all starts from here. All right. So 1 p.m. New York guys go home. The only trading desks open, right? While your East Coast capital markets, so Toronto, Montreal, they're still in their desks. And then you think, all right, Western Europe, they, will trade. It's evening there, but they do have their A teams still, seated in their seats at the desk because they have to trade with New York as a counterparty. So it's, important hours to be staffed in Western Europe as well this time frame. But what we saw is that 4-week T-bill, it got bid down 80 basis points, right? Which is crazy. So 80 basis points. The policy corridor right now is 3.5 to 3.75. That's where the FOMC left it as of last Fed meeting. They're not going to cut right away. They're just like, let's wait, let's hold steady right here. What these offshore markets showed is, like we talked about it, the energy crisis, all of that, everything out of Hormuz, that has constrained borrower demand for money. It means these banks, these financial institutions, all of that, they don't have any customers who are like, hey, we want to ramp up, we want to borrow more. And then that means the money center banks themselves, where they go to tap the money markets for their marginal dollar, they're also saying, hey guys, we don't need to create any more money here. We don't have any demand. So what do? All right, they're sitting on a large supply of currency, right? The currency isn't destroyed yet. That could come down the road. When I say destroyed, what I mean is those existing, supply of currency, and it's going to be primarily dollars as the biggest pool in foreign exchange. If this demand now starts going down further, right, or just keeps shrinking, eventually it turns into everybody is paying off their debt, right? And that's when I say like currency would be destroyed or
I see.
money would be
It's coming back
destroyed.
out of the
That's
system there. Yeah.
yeah, and that's your flywheel. That's your lack of growth. And like where this leads is like it's a disinflationary impact. Like it's growth reducing, which is exactly what your European officials just said. Like they acknowledged it, they admitted it. So this whole oil squeeze, $200 oil, okay, like we'll see higher prices here in response to that emergency supply shock. But the writing is on the wall. This is actually disinflationary from a credit money standpoint, which is the offshore dollar, euro dollar structure that is in process of being replaced with the next thing.
Right.
So yeah, I just read that move. We saw is excess money. There's greater supply of money, particularly offshore. And we know that like the hours 1 p.m. Eastern and after was when domestic markets were closed. By definition, this impact was offshore activity or offshore influenced activity.
Right.
And you saw it here. It wasn't just the 4-week T-bill. The FOMC, they manage like literally Federal Open Market Committee that they have an open market trading desk. What they did here to reduce the flow of dollar supply offshore coming onshore to keep their policy corridor steady. What they did Monday afternoon was they lowered the rate for SOFR is overnight, but they have longer term. They have a 1 week, 2 week, 1 month. Those were lowered for Monday only. The Monday special, that's the blue box. Those got lowered into the three threes to protect that policy corridor from 3.5, 3.75. Basically, um, allowed New York to maintain that 3.5, 3.75, which is where the U.S. economy wants rates to be. So we've got this dynamic where the domestic U.S. economy still supports that higher rate corridor. If you look at the Atlanta Fed GDP now forecast for Q2, it's at like 4. And that's the real growth number. So U.S. economy is growing at a 4 real
We're humming.
on
Yep.
top of this elevated CPI inflation impulse, which was 4. You can already see it rolling over in the March and then April print. We talked about this before. The composition for April, it was the monthly change was down from that March peak, and then it shifted from the actual energy, mark to market pricing of all the way from like oil itself to refined products. You saw owner's equivalent rent just fill in that gap, which is I mean, it's a survey number, so it's becoming less and less market pricing to just feels to maintain that higher CPI print. So eventually, as the rest of the world, that deflationary or disinflationary impact, which could potentially turn into deflation, right, which is negative growth in money supply or credit in the private sector. That's really what we're looking at here with this backdrop, in my opinion.